a money-saving offer and some information to help you beat the tax man when you need it most. I'm Eric Renner. Join me right now for Your Wealth Health. Hello and welcome to Your Wealth Health. I'm Eric Renner, owner and founder of Hilltop Wealth Solutions, and I want to thank you for joining us this morning. If you're watching us on Facebook, please share us with someone who could use this information. And thanks as always for watching us on yourwealthhealth.com. Joining me today is Bill Davis, a private wealth advisor at Hilltop, and Bill is in the studio with me, but we are continuing to practice social distancing. And we have a fantastic money-saving offer for you today, and we believe that you should take advantage of it, and we'll even save more money. And we're going to tell you about it in just a few minutes. It's going to involve a phone number, so please get something to write with and get your phone ready or your laptop ready. We are offering is connected to our discussion today. We're talking about a strategic tax plan that can help save you thousands and thousands of dollars, especially during your retirement. We have a few quotes we want to show you from some very respected businesses that follow and report on financial news. And the first is from Motley Fools. And that says, if you're not careful, you can ruin a lifetime of successful savings when it comes time to withdrawing money from your nest egg. From Fortune, they had a quote that says, the U.S. will likely impose monumental tax increases in the next decade. And from Kiplinger, you have a silent partner in your retirement, and his name is Uncle Sam. We also have a quote from Ed Slott. Ed is one of the country's most respected experts on tax strategy, and we are all members of his elite advisor program, and we've had Ed on Your Wealth Health. And Ed has a quote that we really, really like, and it talks about retirement planning is like a football game. There are two halves, and the score at the end of the game is what counts. The first half is the accumulation of wealth, and most advisors are good at that. The second half is about protecting money and preserving it. The IRS often wins because they are playing the second half against nobody. So, Bill, these are quotes addressing really a concern or a problem that we see for many people, the lack of good tax planning.
Yeah, and I think that people, they don't assume that taxes are going to go up in the future. So I think, the fundamental of what these people are saying is that we're at the lowest tax brackets that we're probably ever going to experience in our life. And no matter what political favor you're in, there's going to have to be an increase in taxes probably.
Yeah, and we've said on the show, right, we're at a 40-year low.
Right.
I mean, and with the global pandemic and everything that's going on now, I mean, you listen to analysts and economists and so forth, and taxes are going to go up at some point.
That's right. And so, so even if you accept that, have you done any planning to determine how those increases in taxes are going to affect you in your retirement income plan? So, I think we've been talking on this show for some time now for our viewers that, this planning needs to take place between probably age 60 and age 72. So wherever you fall in that range, now would be the time to not do tax preparation. We're not talking about tax preparation. We're talking about true tax planning and predicting into the future where your retirement income streams are going to come from, and how are you going to make sure you leverage those within those tax brackets that are today and into the future.
So retirement's important in making that plan, and as Ed Slott says, planning for the second half, but also in saving for retirement. So I know, even a few years ago, it was about putting it into your retirement plan, pre-tax, just save, and now many 401k plans have Roth IRAs. So we have taken a bit of a different position, right, for people starting or that are saving to try to build up some of that, tax-free or after-tax money.
You're right, Eric. It's all about the accumulation phase. So this sweet spot of people between the ages 60 and 72, many of them are still working. So they have choices to make. Do I do pre-tax? Do I do after-tax? Do I try to do both? Because there's other strategies even for higher income earners that can do backdoor Roths, which is not commonly considered a strategy. But of course, the maximum contribution would be, within the retirement plans, within the 401ks, and would give you the largest amount of contribution without doing things like backdoor Roths and stuff. So yeah, so because most of these people are in their accumulation phase still, they have options on where they save. And so, if you understand that we're in the lowest tax bracket today, putting in before tax money is the least amount of tax savings that we've ever had. So maybe now would be the time to be doing Roth within your 401k. And from all the years that we've been doing this, 24 years for me, it's most common that the largest accumulation is in that before tax dollars. And so therefore, that has the largest negative implications in the future at higher tax brackets.
So do we find that most advisors don't really think about this more comprehensively tax-wise, right? Maybe they're limited with the company they work with. So a lot of companies, large company, broker-dealers, don't allow advisors really to go into true tax planning. And we find that clients may be left a little bit short on that.
Yeah, depending on the type of relationship that the advisor has. So, if they're working under broker-dealer arrangements, it's pretty common that those broker-dealers have pretty strict regulations about doing tax planning. So yeah, having a fiduciary advisor, registered investment advisory firm like Hilltop, one of the first things that we want in the collection of the data is last year's tax return, because I'm not sure how you could really give comprehensive advice without disclosing, really digging in deep into the tax return. And so today we're going to give some true examples of, why giving your fiduciary a copy of your tax return is so important. And, we really can't do our job comprehensively without that information.
And I know there's been some, studies done over the years from our industry on how many advisors actually collect a tax return, and it comes back as often more than 90% of advisors don't even collect a tax return in the client relationship, which is pretty amazing because that's like your physician not taking your vital signs.
Yeah, it really is. And and I understand many of those advisors are restricted from collecting that information, but what we've come to understand and believe is, we just can't, like you say, just like having a doctor going into an examination without any information about the patient, we need that information to be able to do our job accurately and correctly.
And the other thing that we talked about on this show is the importance of this is just because of the way people are saving money, right? 15, 20 years ago, people had pensions. They got Social Security pensions. They got full benefits when they retired. And now they're more responsible for savings. So they have an accumulation of savings that may be all taxable. Right. At retirement.
That's the most common problem. And so there's where we need to estimate how their accumulation is going, what's going to be the buckets of money that they're going to accumulate over the next, 10 to 12 years, so that we can then predict how we will start to do the withdrawal strategy, the retirement income strategy, taking into account that if all of their money's in after tax, or all their money's in before tax, which is most common within a 401k, we're on track for some issues with required minimum distributions that could put people in a higher tax bracket. It could make their Social Security taxable. So there's a lot of work to be done today during their accumulation phase to not wait. And it doesn't mean that they can't do planning after they've achieved age 72, but it's a little more difficult.
Thanks, Bill. We are providing a complimentary tax analysis, but you must call the number on your screen to sign up. We're going to underwrite the cost for the first 10 people who call. Now, a lot of firms would charge $1,500 to $2,500 for this service, but we're not going to charge you a dime. We're actually going to underwrite that as a firm. The number to call is 574-633-1476. Once again, that number is 574-633-1476. We have people standing by to take your information right now. So please take a minute and call to get your complimentary tax analysis. You can also go to our website at hilltopwealthsolutions.com to sign up for this complimentary service. So Bill, what would people need for this tax analysis we're going to offer?
Really simple, Eric. Usually we just do about a 30-minute call, phone call, Zoom call if the client wants or the prospect wants, and talk through their situation to determine whether going to the next phase would make sense. So we can see kind of approximately what tax bracket they're in. I would recommend they have their tax return available for themselves to look at when we're having the conversation. And then I think from that 30-minute conversation, 30-minute conversation, then we have ways to share files that we can then go on to the full analysis.
Great, thanks Bill. So maybe you're still wondering, what specific advice could I really get that would make a difference? When we come back on Your Wealth Health, some specific case studies involving people just like you. And once again, here's that phone number to call for your complimentary tax analysis. Stay with us.
I cannot work, do e-learning, and keep this house clean.
You should try Kay's way. We heard you were dirty, so we came in a hurry. We can't help you with the e-learning, but we can help you with the cleaning. Try Kay's way.
Built on a legacy 4 generations strong. Clayton Hoover & Sons Home Improvement. More than just our business, it's a family legacy.
Welcome back to Your Wealth Health. I'm Eric Brenner, the owner of Hilltop Wealth Solutions, and I'm here with Bill Davis, one of our private wealth advisors, and we're talking about tax planning and strategy, especially for those that are going to be retiring or are retired. And we want to get into a specific case here, and so we want to begin with a case that is an actual case. Obviously, we took off names, but I wanted to show this graphic. And, Bill, this is an input screen that we utilize in a software program to really analyze someone's tax situation. And I'd like the viewers to take a look at the entry there is somebody had $48,000 of Social Security. We often see this that, they're living okay on Social Security or their projected retirement income. And, I think a lot of people, Bill, would think that they probably pay some taxes on that.
Right. And they're a long way from paying any taxes on their Social Security. And this is one of the most important factors that we take into account is can we take income from other sources that will positively affect the outcome in the future. And so, but the first step is people understanding that Social Security is not taxed unless they hit certain income limits from other sources. And those other sources, as is indicated on the screen, is earned income. So are they working part-time? Do they have other ordinary income sources? Do they have things like pensions? Are they drawing money from an individual retirement account that would be a taxable event? So all of these things are going to come into play as it relates to determining Social Security taxability. But the baseline that you've started here with this case is that they're living on $4,000 a month and they're letting their other assets grow, and that's really kind of where we see the opportunity.
Yeah. So then we move on to really this illustration that shows, as we said, an income of $48,000, and they actually have zero in taxes, and they may feel good about that. I think this client certainly did. And that we really look at two kind of different tax brackets, if you will. I mean, one is the marginal tax rate, and that's oftentimes, Bill, what people say, you know, what bracket are you in? I'm in the 15% bracket, or I'm 22% bracket. But really, the marginal rate is where your last dollar falls into. So you could have $1 in the 22% bracket, and then there's the effective rate, Bill, and that's really what we manage.
Yeah,
is the
so
effective
most
rate.
people, so someone will say, hey, I'm in the 22% tax bracket. But my experience is those people are in the single-digit effective tax bracket, effective tax rate, and that's the amount that they're actually paying in taxes. So, in this scenario, what we're going to see is these people can actually take out taxable income because there's such a gap between, until their effective tax rate kicks into actually having to pay some taxes. That's pretty significant, and a lot of people just don't understand the difference between marginal and effective, and so they're managing to the wrong numbers, so to speak. And so this Covism software that's called Tax Clarity, it allows us to do what ifs, and so that's basically what we're sharing with our viewers here, is how we can do these what ifs to determine, hey, can you take out more income, possibly reposition it to a different taxable bucket, or use it for lifestyle purposes, or upgrades to their homes or vehicles or other things that they'd want to use it for, and not pay any tax.
Yeah.
Crazy.
So let's take a look at that. So what we did, or what's done with this client in this case was, well, how about if we kind of rearrange, if you will. And so if you take a look at the screen, again, we have these entries, and we still have the $48,000 of Social Security, but then they had some long-term capital gains that they could take off of some mutual funds and stocks, and that equated to about $20,000. And then we looked at taking an IRA distribution of about $12,000. So obviously it increased their income up to $80,000. Now you may say, well, maybe they don't need the $80,000, but they could reposition assets that would help them in the future from a tax perspective. And so I think, in this case, I know they were surprised, but Bill, a lot of times people are surprised that I went from $48,000 to $80,000 income. How much more tax did I pay?
Yeah, and you have to realize that it's taking advantage of a lower capital gain rate, which, that's low-hanging fruit for this next administration to potentially increase the amount of capital gains taxes that people would have to pay. So this is taking advantage of the lower capital gains rate, possibly zero, and then that marginal gap that they're able to take the $12,000 out tax, basically tax-free.
Yeah.
I mean, what are we talking about? $80 in tax on $80,000 of income?
Yeah.
Is what most people just wouldn't believe would be possible.
Right. So they're on, and shown on the graphic there is $80,000 of income with $80 of total federal taxes. This does not include state,
right,
which we do take into account, but total federal taxes. So a pretty big jump that could be some repositioning of assets. And it just amazes me, Bill, how many times people make decisions and they don't understand how it's going to influence the tax situation.
Right, and so it goes. What's not said here is what would you do with the money if you don't need it. Mm-hmm. So we're looking at laying out options for a client that would be maybe that $12,000 of money coming out of the traditional IRA or the 401k. Maybe we could convert that to a Roth position because we're not going to pay any tax on it. Many times we even go into the next tax bracket to convert Roth money, knowing that we're in the lowest tax bracket today. But another option that could be available to them is to just put it into a non-qualified investment bucket, because that's going to generate interest, dividends, and capital gains that are all taxed at a lower rate, as we see in this example. So not just doing the tax calculation through the Tax Clarity software, but also laying out options for the clients that where are you going to reposition this to? What are you going to do with the money?
Yeah.
And so those are all things that are on the table for the strategy part of this discussion.
Yeah, great. Thanks, Bill. So once again, we at Hilltop Wealth Solutions want to help you avoid costly mistakes, and we're offering a deal that you or someone will want to take advantage of. we are providing a complimentary tax analysis, but you must call the number on your screen to sign up. We're going to underwrite the cost for the first 10 people who call. Now, you could pay $1,500 to $2,500 at other firms, but we're not going to charge. We're going to actually underwrite those. So that number is 574-633-1476. Again, the number is 574-633-1476. And we do have people standing by to take your information right now. So please take a minute and call to get your complimentary tax analysis. And you can also go to our website. Right on our website, hilltopwealthsolutions.com. We got a place to sign up there for a free analysis. And so we encourage you to do so. So how does tax planning fit into the big picture of retirement planning, and what exactly is the role of a fiduciary financial advisor? We'll break it down for you when we come back on Your Wealth Health. And once again, here's that phone number and the information for you to sign up for your complimentary tax analysis. We will be right back. Welcome back to Your Wealth Health. I'm Eric Brenner along with Bill Davis, and we want to talk about how tax planning fits into the big picture when it comes to what we do as fiduciary advisors. And we have a graphic to help explain it, and we call it the forward-looking tax plan. And so, Bill, we want to put this wheel together for people.
That's right. Yeah, so what you'll see there is, RMDs, that stands for required minimum distribution. We want to know how much Social Security is being generated by the household. We want to know what their investment plan is. So do we have any non-qualifieds kicking off capital gains, dividends, interest? The legacy planning is, how is this accumulated assets going to pass to the next generation? And what would be the taxability of that? Income distribution is, where are we going to pull the money from? So if they have separate buckets of money, how are we going to complement their retirement income? We currently have a Medicare surcharge called the IRMA tax. And so we need to understand that based on the amount of income that they're generating, how much will their Medicare premium be affected? Because that's a big deal, because it's coming out of their Social Security check. Mm-hmm. And so, that could be a big number. It could be a household of over $700 a month coming out of their Social Security check if you make a mistake in that area. So it's in a wheel because, where I think a lot of advisors don't put it in this perspective. They don't look at all the aspects and explain to clients how they're all going to affect them during their retirement years. And if they're not retired, we can project forward these items. And then how's it going to affect the next generation as it relates to the legacy that they want to leave for the next generation?
And I know one of the things, Bill, that I'm big on as the firm is education. And so we do a lot of training around education, really, that doesn't have to do with products. And I know a lot of firms, this year there's not a lot of conferences going on, if any, but they're doing a lot of virtual. But, there's a lot of conferences and learnings that can go on, but a lot of times they're tied to products, annuities and other products, where we do education around Social Security, So we do a lot of education there, Bill. And then the Ed Slot program, Ed Slot Elite Advisor Program, and Ed's been on the show, that we participate in, our advisor team participates in. And, there's 400 advisors in the country that are in the Elite Advisor Program. And I think, there's about 300,000 financial advisors in the country.
Yeah, and the National Social Security Advisor Program that we're both a part of, that that training is very extensive, and just all of these things matter.
Yeah.
And so we need to be up to speed on everything from Social Security, Medicare, income tax planning, estate planning. All of those things are important, and that's why we continue to drill down to help people understand what a fiduciary is and what a fiduciary is not. And in your case, you brought up, Eric, things like, insurance salespeople. They would primarily focus on annuity sales. People that might be Series 6 licensed that just sell mutual funds. Could be high-priced mutual funds as well. And so, it's really important that people understand and ask the question of the people that are giving them advice, whether they're truly a fiduciary, which in our case means we're not going to recommend any solutions that are not appropriate for each individual client, and every client is individual.
When it comes to this tax, and particularly that legacy part, is people have a choice on where their money goes, right? They can leave it to who they love and care about, they can leave it to charity, or they can leave it to the IRS.
That's right.
So,
and we're hoping to avoid the latter.
Right. But it does take planning, and it really is based on because people have more accumulation of assets.
Right.
Again, 15, 20 years ago with pensions, once they passed on, those pensions didn't get passed on. Social Security benefits don't get passed on, and so there may have been very little as it relates to assets available to pass on. And now people have these pots of assets that they want to make sure that it's going to where they want it to go.
And I think just about every person that I've worked with, especially over the last maybe 10 years, are very surprised at the amount of assets that they've been able to accumulate. Even just middle-class individuals with the with the onset of 401ks and matching employer matches and things like that, the power of compounding, the growth of people's assets are kind of surprising to a lot of them.
Yeah, great.
Yeah.
Thanks, Bill. So we didn't have enough time really to get into all the different aspects of developing a good tax strategy. So we want to continue this next week. We're going to talk more about required minimum distributions and the impact of the new legislation known as the Secure Act. That's kind of got pushed aside with everything else that's happened this year. And we also have a detailed article on tax strategy on our website, and you can access that by going to Hilltop Wealth Solutions, click on Retirement Resource tab, and then click on Guides. It's a good reading, and it addresses many of the issues we are discussing on this show today. Well, we're just about out of time here, and I want to remind you about the offer that we have in providing that complimentary tax analysis, but you must call the number on your screen to sign up. We're going to underwrite the cost for the first 10 people who call, and this is normally $1,500 to $2,500 at other firms, and we are not going to charge for that. So we're going to have you call the number 574-633-1476. Again, the number is 574-633-1476. We have people standing by to take your information right now, so please take a minute and get your complimentary tax analysis scheduled. And you can also go to our website to sign up for this complimentary service. We're out of time for this morning's show. For Bill Davis and the entire Hilltop staff, I'm Eric Brenner. Thank you for watching, and we'll see you next week. Stay wealthy, Michiana.